Welcome to the Pro Ticker Deep Dive. Today, we're trying to cut through some serious noise in the late 2025 economy. It really feels like a tale of two economies, doesn't it?
It absolutely does. You've got this remarkably resilient consumer on one side,
Still spending.
but then, bam, you have these big external policy shocks hitting hard.
Like the government shutdown, the longest ever, and all this tariff uncertainty hanging over everything.
Exactly. And our mission today is to figure out which of these forces is really driving things as we look ahead to 2026.
The contrast is just wild. We're about to see consumers potentially break the $1 trillion mark for holiday spending. First time ever.
The huge number.
Huge. But at the same time, this shutdown is just bleeding billions from the economy week after week.
So what gives? Which narrative wins out for investors?
That's the question.
And, that contradiction is precisely why the market's been so jumpy. Bifurcated is the right word. Sure, consumer strength and maybe some early optimism got the S&P to that record high. What was it, 6,875?
Yeah, late October. Didn't last long, though.
Not at all. Volatility kicked in almost immediately. Policy headwinds took over the narrative.
So it's this underlying strength fighting against, well, political drag.
And that friction.
Yeah.
That's causing these big market swings we're seeing.
Okay, let's dig into that consumer strength first. That $1 trillion headline, you just can't ignore it.
No, you can't.
We're talking projected sales, what, $1.01 to $1.02 trillion?
Mm-hmm. Which translates to about 3.7% to 4.2% growth.
On the surface, that looks incredibly strong, right? Especially with living costs being so high.
It does seem like real staying power, but, and this is a big but, you have to look beneath that aggregate number.
Okay.
When you slice the data by income level, you see this pretty deep fracture. It tells you where the money's really coming from.
Mm-hmm.
Our sources show something like 65% of high-income consumers planning to spend the same or even more than last year. Solid.
65%, okay. What about lower income folks?
That's where it drops off sharply.
Hmm.
Only 48% for lower income households.
Wait, only 48% plan to keep spending levels steady or increase them.
Yeah.
That feels like a massive vulnerability hidden inside that trillion-dollar number.
It really is.
If it's mostly the top third driving the spending growth, doesn't that make the whole thing kind of fragile, reliant on a small group?
Precisely. That split is where the good news sort of ends and the stress becomes visible. And we see real evidence of that stress. There's this trading down dynamic showing up, especially among lower and middle income groups.
Trading down? Like how?
Well, around 26% are actually switching their grocery shopping to discount stores.
Oh, okay.
And even more, about 35% are picking cheaper items within the stores they usually go to.
So this isn't about saving for a big splurge. This is necessity.
Exactly. Inflation's outpacing wages for a lot of these households. They have to cut back somewhere.
It's interesting how the market seems to reflect this fragility.
How so?
Well, you'd think a $1 trillion forecast would light a fire under the whole retail sector.
Right.
But the consumer discretionary sector ETF, XLY, its return through September was, frankly, pretty underwhelming. Only 12%.
Which lagged the broader market significantly. The S&P did over 15%, right?
Yeah, 15.47%. So discretionary spending isn't really leading the charge.
And even that 12% for XLY is a bit misleading
How's that?
because of concentration risk. The ETF's performance is really tied to just a handful of mega-cap giants.
Ah, like Amazon and Tesla.
Exactly. And Amazon's strength often comes more from its cloud business, AWS, not purely retail, and Tesla. Well, they're facing serious margin pressures from competition, input costs.
So if those big names wobble, the whole sector looks weak, even if smaller retailers are doing okay.
That's the dynamic. It masks the underlying breadth, or lack thereof.
But you mentioned a silver lining in services spending.
Yes, that's held up much better. People seem to still prioritize experiences.
Travel, restaurants, hotels, that sort of thing.
Right, we're seeing resilient same-store sales there. It helps cushion the weakness in goods, like, say, autos or apparel.
So people might buy cheaper groceries, but they'll still pay for a trip or a nice meal out.
That seems to be the trend. It's a structural shift that's been going on for a while. But even that strength is now bumping up against these policy headwinds you mentioned earlier.
Okay, yeah, let's pivot to those policy shocks. They feel very immediate right now.
They are.
This government shutdown starting October 1st, it's just brutal, longest in history.
And the economic cost is piling up fast.
What are the estimates now? Something like $18 billion lost from Q4 GDP already?
That's the ballpark, yes.
Yeah.
And it could hit close to $39 billion if it keeps going through late November.
$39 billion, that's a staggering.
It's a massive drag. And it's why Q4 GDP growth forecasts have been slashed so dramatically.
We were humming along at what, 3.8% in Q2?
Yeah, pretty robust.
Yeah.
Projections for Q4 are down near 1%, almost entirely because of the shutdown.
Just 1%. Wow.
But here's the part that's, frankly, more worrying for the longer term. This might not just be a temporary blip. The CBO, the Congressional Budget Office, they put out estimates. They think an extended shutdown could wipe out somewhere between $7 billion and $14 billion in permanent economic output.
Permanent. You mean gone for good,
Well,
not just delayed activity that catches up later.
that's what permanent means here. It's
Well.
economic potential that's just lost. You don't get it back.
That feels much more significant than just delayed paychecks. That suggests lasting damage, scarring.
Exactly. It's economic scarring. And that kind of uncertainty, that kind of permanent loss, it changes behavior. It affects business confidence, hiring, investment.
Financial commitments, yeah.
You really see that scarring effect showing up on the industrial side of the economy.
Right. Let's look at industrials. They had a good run early in the year, didn't they? All that buzz about reshoring.
They did. There was a lot of optimism about manufacturing returning to the U.S.
But that narrative seems to have fizzled out completely.
It has. The data is pretty clear. Industrial production growth, it slowed way down, just 0.9% year over year through August.
Less than 1%. That's barely growing. What killed the momentum?
It's a mix of things. Cooling demand globally, for one. But the trade friction is a big piece of it. Tariffs.
Ah, the steel and aluminum tariffs, those are still in place.
Yes, 25% duties on many of those products. And they're adding significant costs for manufacturers. We're talking input cost increases ranging from maybe 2% up to 4.5% for some sectors.
Which sectors get hit hardest?
It varies, but areas like computer and electronic products seem particularly vulnerable. They're seeing increases over 3.5%.
So wait, the policy was meant to help U.S. manufacturing, but it's actually raising costs for U.S. manufacturers.
That appears to be a major, perhaps unintended consequence. It directly undermines the goal of making U.S. production more competitive.
It really challenges that whole bullish industrial story.
It does.
Yeah.
And talking to businesses, what really seems to be the issue isn't just the level of the tariffs. It's the uncertainty.
Unpredictability.
Exactly. Why would you make a huge multi-year investment in a new factory or equipment if your input costs could suddenly jump based on the next policy decision or tweet?
Right, you just wait. You defer that spending.
And that's what seems to be happening. That hesitancy, driven by policy uncertainty, has basically stalled out that manufacturing renaissance before it really even got going.
Okay, let's connect this policy mess back to the bigger macro picture. The Fed, they cut rates twice this year, right? September and October.
They did. Brought the Fed funds rate down to that 3.75% to 4.00% range, which normally would be supportive.
But what's their thinking now with the shutdown ongoing?
Well, the shutdown's thrown a wrench in their works. A big one.
How so?
Data gaps. They rely on fresh government data for things like employment, inflation, and they haven't been getting it reliably for the past month or so.
So they're flying blind, essentially.
To some extent, yes. And that makes it much harder for them to justify another rate cut in December, even if the economy is slowing. It's why their recent comments sounded maybe a bit more hawkish than the market expected.
Yeah.
I need to see the data.
Makes sense. What about the labor market itself? That was a source of strength.
It's cooled off.
Yeah.
Which, the Fed probably sees as a positive for fighting inflation.
Wage growth slowing down.
Yeah, average hourly earnings growth came down from over 4% early in the year to under 3% by mid-year, around 2.9%.
But is that cooling happening fast enough to help people's wallets?
That's the crucial point. For many, no. As of June, something like 43% of workers still had wage growth that was trailing inflation.
43% falling behind.
Which brings us right back to why that lower income group is feeling squeezed and having to trade down. Their purchasing power is eroding.
Let's talk market technicals for a second. That S&P swing, from below 5,000 in April to nearly 6,900 in October, that's a huge move.
Massive volatility. It really reflects that internal conflict we've been discussing.
What did that peak look like from a technical perspective? Was it strong?
Actually, no. It showed classic signs of exhaustion, what analysts call declining breadth.
Meaning fewer stocks were participating in the rally.
Exactly. The index was being dragged higher by just those few mega-cap leaders we mentioned earlier. Not a healthy sign.
And the VIX, the volatility index.
That spiked up sharply when the shutdown news hit, and it's stayed pretty elevated since then.
So professional investors are still nervous.
The elevated VIX certainly confirms a high degree of skepticism about whether this rally can hold. There's doubt out there.
And valuation-wise, The S&P trading over 21 times forward earnings. That seems high, given the headwinds.
It leaves very little room for error. Absolutely.
Yeah.
Think about it. If Q4 GDP really does slow to 1% because of the shutdown damage, earnings estimates have to come down.
Right.
And when you have high valuations combined with falling earnings estimates,
Right.
well, that's a textbook setup for a market correction, what we call multiple compression.
Okay, so that paints a pretty cautious picture. Let's try to frame the path forward. What's the bull case? The optimistic take.
Well, the bull argument basically says these pressures are temporary noise.
It's just noise.
Get a quick resolution to the shutdown, the back pay floods into the economy.
And that delayed spending pushes Q1 2026 growth back up, maybe 3% or more.
That's the idea. A strong rebound. Plus, the underlying structural strengths are still there.
Like the trillions in excess savings consumers still supposedly have.
Right. And unemployment, while ticking up maybe, is still historically low at 4.2%. The foundation is reasonably solid.
So the economy can weather a short storm.
That's the argument. And crucially, if inflation keeps cooling into next year, the Fed has the green light to cut rates more aggressively if needed.
And easier money helps growth stocks.
Always a tailwind. That's the bull case in a nutshell. Resolution, rebound, and supportive Fed.
Okay, now the bear case. Why might this be more serious than just a temporary dip? What makes this different?
Because the evidence of a structural slowdown was building before the shutdown even started.
Like that weak industrial growth.
Exactly. Industrial growth stuck below 1%. That's not just a blip. That's anemic. Add in the margin pressure from tariffs. It suggests the economy was already entering a tougher phase. And then there's that permanent scarring we talked about.
Yeah.
That's $7 to $14 billion in lost output. You can't just brush that off.
It suggests that the policy uncertainty isn't just noise, it's doing real, lasting damage.
It seems to be the single greatest impediment, as some analysis put it, to that manufacturing recovery everyone hoped for.
Which naturally leads to the R word, recession. We keep hearing warnings.
Yeah, the more bearish scenarios are now putting the probability of a genuine recession sometime through the first quarter of 2026 at around 40%.
The 40%, that's not insignificant.
Not at all. And if that happens, think about the Fed's position.
Yeah.
They'd be forced to cut rates aggressively, sure.
But into an environment where inflation might still be kind of sticky.
Precisely. Cutting aggressively when inflation isn't fully tamed. That's a recipe for stagflation, or fears of it. And that environment really punishes cyclical stocks, small caps.
Okay, so let's try to synthesize this for listeners. It's clearly complex, late cycle stuff.
Very much so. You've
Right.
got consumer strength. That $1 trillion number proves it's real. But it's also impaired, especially for lower earners. That's truth number one. Truth number two, the industrial recovery. Stalled out. Dead in the water for now.
And the deciding factor seems to be.
Policy uncertainty. The shutdown fallout, the unresolved tariffs. That's the critical variable dictating where we go heading into 2026.
So practically speaking, what are the tactical takeaways for you, the listener? How do you invest in this mess?
Well, you have to balance those truths. First, that 40% recession risk.
Yeah.
It's high enough that you probably want some defensive positioning.
Meaning?
Favor quality, businesses with strong balance sheets, pricing power.
Yeah.
Companies that can handle margin pressure better than others.
Okay, and watch the market levels.
Definitely. Keep an eye on technical support. Around 6,400 on the S&P 500 seems to be a key level right now. If the market rallies above that, maybe use it as a chance to take some profits, trim some risk. I wouldn't be chasing strength here.
And look for potential entry points lower down.
Yeah, watch for a more decisive break lower, maybe down towards the 5,700 area. If we get there, it might signal that the market has started pricing in the earnings revisions needed because of the shutdown damage. That could be a better spot to add exposure rather than up here near 21 times earnings.
Got it. And maybe one final thought for people to chew on. Even with that $1 trillion holiday spending milestone, think about how we're getting there. The actual volume of stuff being bought might be slowing down. People are trading down.
Right. It suggests future revenue growth for retailers, for discretionary companies. It might depend less on selling more stuff and more on their ability to raise prices and protect their margins.
Which means you need to be really picky if you're betting on broad consumer spending strength next year. Pricing power becomes key.
Absolutely. It demands a lot more scrutiny from investors.
Okay, that's a lot to think about. Great insights. See you all in the next Pro Ticker Deep Dive.